Hello and welcome to this session on depository receipts. You have understood the basics of equity products. In this topic, we will go a little deeper and understand the extended products of equity, namely depository receipts. In this session, you will learn about what are depository receipts, the features of depository receipts, the advantages of depository receipts to both investor and issuer, and the types of depository receipts, which are American Depositary Receipts, Global Depositary Receipts, and Indian Depositary Receipts. Let's start with the basics. What are depository receipts? Let's begin by first understanding what a depository receipt is. A depository receipt is a negotiable certificate that represents the already traded debt or equity of a company from a country to a foreign land. Let's say company A wants to get its security listed in another country in the form of DRs. This company approaches a local depository custodian from the said market, which in turn goes to the global depository. The global depositor will issue the DRs when all the terms and conditions are met from the said market. Now these DRs are given to the local depository's custodian, who further passes on these DRs to company A. Usually, DRs are issued for every 10 shares, but the ratio can be customized. Depository receipts facilitate trading in foreign securities. They can be traded on an exchange or over the counter. They can also be used to raise capital through exchanges. Now that we know what depository receipts are, let us learn about the parties involved. Now the parties to a depository receipt include brokers, depository, custodian, the issuer, as well as other players like investment banker, lawyers, and accountants. The issuer who is interested in DRs has to approach an investment bank, lawyers, and accountants associated with this subject market. These will help the issuer in raising capital through DRs in a more systematic and legal manner. On the other hand, the issuer also has to approach a local broker, depository, and a custodian to complete the procedure of issuing and distributing the DRs in the said market. So how does a depository receipt actually work in the real world? Let's say a company has fulfilled the requirements for depository receipt listings and now wants to list its publicly traded shares on the New York Stock Exchange. So first, the Indian company X has to contact a broker or a merchant bank to make purchase of its shares. The broker or merchant banker purchases ordinary shares and hands them to the depository bank's custodian bank. The custodian bank notifies the depository bank, who issues depository receipts on the NYSE exchange. The depository receipts thus issued now represent the local US shares and can be traded freely on the New York Stock Exchange, and Company X can thereby benefit from this issue. Let's not familiarize ourselves with the features of a depository receipt. First, DRs are traded on a local stock exchange even though the foreign public company is not listed on these exchanges. DRs are physical shares, just like equity shares, thereby allowing the investor to trade in equity of other countries. DRs provide easy access to international stock exchanges without actually getting listed through the long and tedious IPO process. DRs also provide easy access to international currencies, thereby helping the economy's foreign exchange reserve. Finally, from an investor's point of view, DRs give plenty of opportunities to profit from equities of other countries. Interestingly, DRs can be beneficial to both issuers and investors. Issuing companies gain access to foreign markets and investors. DRs help the issuing company in establishing and enhancing its presence in foreign markets. Lastly, DRs are a flexible mechanism for issuing companies to raise capital in the foreign market. Coming to the benefits gained by investors. Diversification. It enables non-institutional investors to invest in international companies and thereby diversify their portfolio without the hassle of geographical or currency restrictions. Investors also have the opportunity to invest in high growth companies that would otherwise not be accessible to them on their local exchange. DRs have their limitations as well. They are high fees. Now, DRs are subject to high fees while buying as well as selling, making them less attractive to non-institutional buyers. The value of the DR and the dividends issued by the underlying company are exposed to changes in the foreign exchange rates, which means your DR would be valued more or less depending on the FX rate. Finally, a DR represents a number of shares in one receipt and cannot be traded in parts. Furthermore, trading in depository receipts is an easy process. DRs once issued and delivered to broker are available for trading. Interested investors could invest in DRs through brokers, and the price of these DRs is initially decided by the issuing broker and the management of the issuing company based on the company's strength. Later, market forces like demand and supply, market conditions, investors' sentiments, and domestic market conditions of the issuing company dominate the DR price. When dividends are paid by the domestic company, the custodian bank receives it and withholds all foreign taxes. Later, custodian bank converts the payment's currency into US dollars or the prevailing currency. The same is then sent to the depository bank, and lastly, the depository bank sends the same to investors. We will now have a look at the different types of depository receipts. Moving on, there are two major types of DRs: American Depositary Receipts and Global Depository Receipts. And to give you a local flavor, we will also cover Indian Depositary Receipts. Let us now learn about American Depositary Receipts. Did you know? American Depositary Receipts cover more than 50% of global depository receipts issued. ADRs have been introduced to the financial markets as early as April 29, 1927, when the investment bank JP Morgan launched the first ever ADR. ADRs represents shares of non-US companies and are still traded on US stock exchanges just like US stocks. Dividends are paid out in dollars. They carry the voting rights, as the DRs are representatives of the underlying company shares. ADRs can be listed on NYSE or NASDAQ. ADR prices are determined by the underlying share's domestic price. Let us now understand the workflow of an ADR. In our example, we have a Russian gas company that wants to get its shares traded in America via ADR. This company approaches a local depository of the US who can facilitate the issuance. This local depository will get in touch with the local custodian who will collect the shares from the company. Post the acquisition of shares, the depository will issue ADRs to local investors in the US stock exchange, which will not be equity but a DR. We calculate the value of an ADR. In our example, suppose the price of the Russian gas company is 150 ruble. Each DR consists of 10 shares. The current USD to RUB exchange rate is 60. So the value of ADR will be 10 into 150 divided by 60, that is $25. There are two types of ADRs: sponsored ADRs and unsponsored ADRs. Did you know, as a result of an SEC rule change effective October 2008, hundreds of new ADRs have been issued, both sponsored and unsponsored. Approximately half of all ADR programs in existence today are unsponsored. Now let's begin with sponsored ADRs. Sponsored ADRs are those DRs issued by a depository to a foreign company whose equity serves as the underlying asset. Sponsored ADRs can be listed on major US exchanges. A sponsored ADR creates a legal relationship between the ADR and the foreign company, which absorbs the cost of issuing the security. Foreign companies use ADRs in order to tap into the capital markets of the US. Investors who may typically focus on domestically listed companies are given the opportunity to obtain returns from higher growth of emerging markets. Unsponsored ADRs. Unsponsored ADRs trade on the OTC market. They are issued without the consent of the underlying company. These ADRs are issued in accordance with market demand, and the foreign company has no formal agreement with the depository bank. Unsponsored ADRs are often issued by more than one depository bank. Each depository services only the ADRs it has issued. These ADRs don't carry any voting rights either. Some of the well-known examples of Indian companies' ADRs are MTNL, Dr. Reddy's, ICICI Bank, Wipro, Tata Motors, Rediff.com, Infosys, SIFI, and HDFC Bank. Now we will look at one of the major reasons to trade in ADRs, that is arbitrage. Now it is commonly known that ADRs and their underlying shares trade independently, although they are fully fungible with each other. The relative prices are not same at all times. Hedge funds and trading firms attempt to capitalize on this asymmetry, generating revenue from periodic, short-term, FX-adjusted price differences between the company's ADR and its underlying local security. Arbitrage is a direct result of changing demand conditions in either the US or the local stock exchange. Regardless of whether the ADR is trading at a premium or a discount, the price differences are always temporary, which is one of the factors that can cause the brief, although sometimes prolonged, upward and downward fluctuations in ADR balances. In the arbitrage trade is to identify which trades can be profitable. Example, ADR price is $10.08, that is ADR at a premium. ORD price in US dollars is $10 US. The depository fee to issue is 3 cents per ADR. The table on the screen shows the action and the corresponding result to it. Identifying opportunity, borrow ADR and sell it short for $10.08. As a result of this, the ADR is borrowed and sold for $10.08. Buy the ORD for $10, implied FX rate included, which is $10.08 minus $10 comes to $0.08 and 1 ORD. Buy ORD for ADR at depository and pay 3 cents per ADR, which is $0.08 minus $0.03 comes to $0.05 and 1 ADR. Return borrowed ADR and close position, which results in the ADR being returned to the lender and a profit of 5 cents. In this example, the ADR is trading at a price premium relative to its local share. The trader executing the arbitrage trade will borrow the ADR and sell it short in the US. Simultaneously, the firm will purchase the ORD on the local stock exchange at a relatively lower price. The firm will then contact the depository bank and issue ADRs at 3 cents per share. Once the firm exchanges the ORD for ADRs, it can return to the lender the ADRs it had borrowed and close out its position. The net effect of the transaction for the firm engaged in this arbitrage is a flat position and a profit of 5 cents per ORD minus the cost to borrow the ADRs. Now moving on to GDRs, that is Global Depository Receipts. Global Depository Receipts, or GDRs for short, are depository receipts of foreign-based companies which are traded in numerous capital markets around the world. GDRs are used to raise money in more than one market. Some corporations use GDRs to sell their stocks in markets other than the one where they have their headquarters. In simple words, GDRs are receipts which represents ownership of a foreign-based corporation's shares which are traded in numerous capital markets around the world. Let us now see how GDRs work. Let's say one ITC share in the Indian market trades at around 1000 rupees, which comes to around 10 euros. The bank buys 100 shares of ITC and issues in the ratio 10:1 in the foreign market, which comes to 1 GDR representing 10 ITC shares, that is 100 euros. Now the subsequent price is determined by market forces as it does for other securities. Now that we know what are GDRs, let's see some examples of GDRs. Few known financial institutes that issue GDRs are Deutsche Bank, Citigroup, JP Morgan Chase, and BNY Mellon. After learning about GDRs, we'll see the advantages of GDRs, which are diversification, which is by enabling an investor to access non-domestic companies with global presence, and that too without geographical and currency restrictions. A GD as a means to increase global trade, which in turn can help increase not only volumes on local and foreign markets, but also the exchange of information, technology, regulatory procedures, as well as market transparency. Examples of GDR are ITC, which is traded on Luxembourg Stock Exchange, Gazprom, which is traded on the Singapore Stock Exchange, and Romgaz, which is traded on the London Stock Exchange. Let us now quickly compare ADRs and GDRs before we move on to the next topic. An ADR is negotiable only in the US, whereas a GDR is negotiable globally. An ADR deals with US dollar only, while a GDR deals with multiple currencies. ADRs are traded over New York Stock Exchange or NASDAQ, and GDRs are traded on the London Stock Exchange, Luxembourg Stock Exchange, and Frankfurt Stock Exchange. The cost of an ADR is higher and legal liabilities are more, whereas the cost of a GDR is comparatively less than an ADR and the liability is also lower. The final type of depository receipt we are going to cover is Indian Depositary Receipts. What is an Indian Depositary Receipt? It is a financial instrument that allows foreign companies to mobilize funds from the Indian capital markets. They are denominated in Indian rupees in the form of a depository receipt created by a domestic depository which has to be registered with SEBI against the underlying equity of issuing company to enable foreign companies to raise funds from the Indian securities market. In an IDR, foreign companies would issue shares to an Indian depository, say NSDL, which is National Securities Depository Limited, which would in turn issue depository receipts to investors in India. Thus, the denomination of IDR will be in rupees. IDR are created by Indian depository and the underlying equity shares of foreign company issuing IDRs. Did you know Standard Chartered Bank's IDR on 25th May 2010 was the first ever IDR issue in the history of the Indian capital markets? Now that we know what IDRs are, how do IDRs work? Let's say a foreign company X wants to issue IDRs. It will approach an Indian depository, say NSDL. NSDL will then buy shares of the company X, convert them into IDRs, which will be listed on an Indian exchange like NSE. The best example is that of Standard Chartered, whose IDRs are trading on both BSE and NSE. We have now reached the end of the session. Thank you for your time.